Bridging the gap, understanding bridging loans. Are you looking to buy a new home, but your current one hasn't sold? That's where a bridging loan comes in. A bridging loan, or bridge loan, is a short-term loan used until a person secures permanent financing. It's like a bridge, carrying you over temporary financial gaps. Ideal for real estate, it allows buying a new home before selling the old. Bridge loans are also used in business for working capital. They are beneficial when cash flow is needed immediately. But remember, it comes with higher interest rates compared to conventional loans. This is due to its nature of quick availability and short term. A critical part of a bridging loan is the exit strategy. The exit strategy is how you plan to repay the loan. For home buyers, this is usually the sale of the existing property. Businesses might have other plans, like securing long-term financing. The bridging loan is typically paid off once this permanent financing is secured. It's like a temporary support that's removed once the permanent structure is in place. To get a bridging loan, lenders will consider your creditworthiness. They also assess the value of the property you're selling or buying. Some might also look at your debt-to-income ratio. Your exit strategy will also be under scrutiny. The approval is quick, usually within days. Once approved, the funds are available almost immediately. But be careful, if your exit strategy fails, you could face high penalties. The repayment terms vary from lender to lender. Some require monthly interest payments, while others roll it into the final payment. It's important to understand these terms before agreeing. Bridging loans are not for everyone. They are best for those with excellent credit and a clear exit strategy. They're also for those who need quick, short-term funding. And they're for those who can handle high interest rates and risks. Before you decide on a bridging loan, consider all your options. Speak with a financial advisor to understand if it suits your needs. Don't forget to shop around for the best terms. Consider the pros and cons before jumping in. Remember, when used right, a bridging loan can help you achieve your goals. But when used wrong, it can put you in financial trouble. Don't let the rush for quick cash make you overlook the details. Take your time to understand the terms and implications. With the right planning and understanding, a bridging loan can be a useful tool. So, whether you're buying a new home or need quick cash for your business, consider a bridging loan. But tread carefully, ensure you have a solid exit strategy. And remember, it's a bridge, not a permanent solution. To cross financial gaps wisely, consider bridging loans. And that's how a bridging loan works in a nutshell. Unlocking the power of assets, their importance in business. Every business, big or small, is built on assets. But, what is an asset? In simple terms, an asset is anything of value that a business owns, controls, or uses to produce income. Assets are an essential part of any business equation. They demonstrate a company's monetary value and financial health to shareholders and potential investors. Assets can broadly be categorized into two types. Firstly, there are tangible assets. These are physical possessions like buildings, equipment, or inventory. On the other hand, we have intangible assets. These are non-physical resources such as intellectual property, brand equity, and customer relationships. Tangible assets are crucial as they are directly involved in the production process. They are the machinery, tools, and raw materials that help create products or services. For instance, a truck owned by a delivery company is a tangible asset. It plays a direct role in generating income by transporting goods. Intangible assets, though not physical, are increasingly important in today's business landscape. They account for a significant portion of a company's value and competitive advantage. Your company's brand value, for example, is an intangible asset. It's what makes customers pick your product over your competitors despite similar features and pricing. Similarly, intellectual property such as patents, trademarks, and copyrights are invaluable assets. They can be monetized and help to maintain a competitive edge. Goodwill, another intangible asset, represents the value of a business beyond its physical assets. It includes factors such as reputation, customer loyalty, and market presence. To understand the importance of assets, consider their role in providing collateral. In times of financial crisis, tangible assets may be used as collateral to secure loans. Moreover, assets support business growth. Profit generated from assets can be reinvested to acquire more assets, driving business expansion. Assets also provide a measure of liquidity. If sudden expenses arise, assets can be sold or leased to raise funds swiftly. A strong asset base provides security against business risks. Even in the face of unforeseen challenges, a company with a substantial asset portfolio is better equipped to weather the storm. Another important function of assets is in the calculation of a company's net worth. Assets minus liabilities equals a company's net worth, a key indicator of its financial health. The management of assets is just as critical as their acquisition. Proper asset management can reduce costs, increase profitability, and improve efficiency. For instance, regular maintenance of equipment can extend its lifespan, preventing costly replacements and downtime. This is a direct benefit of effective asset management. Companies can also lease or rent their unused assets. This can bring additional income, optimizing the utilization of resources. The depreciation of assets is another key consideration. Over time, assets lose value. Understanding this helps businesses plan for replacement costs and tax deductions. In the digital era, digital assets like data, software, and algorithms are gaining importance. They can provide crucial insights, improve decision-making, and drive innovation. Assets, thus, are not just about physical resources or financial value. They include everything that can contribute towards a firm's success. In conclusion, assets are the powerhouse of a business. They are not only the backbone of operations but also the driving force behind growth and success. Understanding and leveraging the power of assets, both tangible and intangible, can make a significant difference in any business's trajectory. In the diverse world of assets, it's important to remember that not all assets are created equal. Some might bring immediate profits, while others ensure long-term stability and growth. The key lies in finding the right balance, knowing when to invest in new assets, and how to manage existing ones effectively. The journey to harnessing the power of assets starts with recognizing their value. So, take a closer look at your assets today and unlock your business's true potential. In the end, assets are more than just numbers on a balance sheet. They are the lifeblood of any business, fueling operations, driving growth, and shaping the future. So, let's remember, assets are not just ownings, they are opportunities. Every asset is a stepping stone to new possibilities, new growth, and new success in the business world. Understanding liability, from examples to disadvantages. Welcome to our discussion on liability, a crucial concept in business and law. Let's dive into the multifaceted world of liability and seek to understand its implications. Liability, by definition, is a legal obligation or debt that an individual or organization owes to another. In the realm of business, liability could mean the financial obligations or debts a company must pay. It could also refer to potential losses from future obligations, such as paying for damages caused by a product malfunction. Conversely, in law, liability pertains to the level of responsibility one has in a situation, often tied to negligence or fault. Let's visualize an example of liability in a business context. Imagine you own a bakery and you borrowed money to buy an oven. That borrowed money is considered a financial liability. Now, consider a lawsuit scenario. If your bakery supplied a cake causing food poisoning, you could be held liable. In both examples, the bakery is financially responsible. This responsibility is what we call liability. Not all liabilities are problematic. Business loans or mortgages, for instance, can be beneficial liabilities. These types of liabilities enable businesses to make substantial investments, like buying equipment or property, which could lead to growth and profit. However, one must always balance beneficial liabilities with the ability to repay, or it could lead to financial downfall. Moving on to the disadvantages of too much liability, the most obvious is financial strain. If a company has more liabilities than assets, it could lead to bankruptcy. Moreover, high liability can also discourage investors, impacting a company's ability to raise capital. In a legal context, if a person or organization is found liable for an incident, it can lead to costly legal battles. Further, the reputation of the individual or organization could be severely damaged. Apart from financial and reputational losses, personal stress and anxiety are often consequences of high liability. The key to managing liabilities effectively lies in balance and diligence. A company should always endeavor to have more assets than liabilities for financial stability. In legal scenarios, prevention is better than cure. By ensuring you adhere to laws and regulations, you can minimize potential liabilities. Insurance is another method to cushion the impact of liability. It can cover potential losses from legal claims or damages. Proper accounting practices are also essential. By accurately recording and monitoring liabilities, businesses can mitigate risks. In conclusion, liability is a nuanced concept. It can be a stepping stone towards success if managed diligently and a stumbling block if neglected. Understanding liability, its examples, and potential disadvantages is essential for both business and personal endeavors. Remember, in the world of business and law, being aware and informed can be the best defense. So, navigate the realm of liability wisely, and may your endeavors be successful and risk-free. Thank you for joining us in this exploration of liability. Stay tuned for more enlightening discussions on these fundamental concepts. Decoding Services, a guide to understanding financial terms. Welcome to the world of finance, where understanding key terminologies can make or break your investment ventures. Today, we are unpacking the term as services. Imagine a world without hairdressers, plumbers, or lawyers. Hard to picture, isn't it? This is because these professionals offer indispensable services to society. Services refer to the non-physical, intangible aspects of our economy. They involve human activities that produce value but do not culminate in physical items. Think of services as the opposite of goods. Goods are physical items we can touch. Services, on the other hand, are actions we benefit from. Our economy is divided into three sectors: primary, secondary, and tertiary. The tertiary sector is where services come into play. The primary sector involves extraction of raw materials. The secondary sector involves manufacturing goods from these raw materials. The tertiary sector is all about providing services. Services are more than just haircuts and legal counsel. They encompass a wide array of economic activities such as transportation, banking, tourism, and so much more. When someone talks about the service industry, they refer to businesses that earn revenue through providing services rather than selling physical products. Let's touch on the financial services industry. It's a major part of the service industry that facilitates economic growth and stability. Banks, insurance companies, and investment firms are all part of the financial services sector. They play a crucial role in managing, investing, and protecting money. For instance, banks offer services like accepting deposits, granting loans, and providing checking accounts. These services are essential for businesses and individuals alike. Insurance companies provide risk management services. They protect individuals and businesses from unforeseen financial losses. Investment firms offer wealth management services. They help individuals and businesses grow their wealth through strategic investment. Financial services also include financial planning. This involves helping individuals and businesses plan for their financial future. These services are so integral to our daily lives that they often go unnoticed. Yet, without them, our economy would come to a standstill. The financial services industry is dynamic and constantly evolving. It embraces new technologies and adapts to changes in regulations and customer preferences. As we move towards a more digitized world, digital financial services are becoming increasingly important. These include online banking, mobile payments, and robo-advising. Financial services are not just about transactions. They're about establishing relationships, instilling trust, and enabling economic growth. The quality of a service is largely dependent on the provider. A good service provider understands their clients' needs and provides solutions that add value. In the world of finance, this translates to providing reliable, secure, and efficient services. It's about meeting and exceeding customer expectations. Not all services are created equal. They can differ greatly in terms of cost, quality, and delivery. This is why it's important to compare different service providers. Remember, as consumers, we have the power to choose our service providers. We should exercise this power wisely by choosing those that best suit our needs and budget. Good financial service providers are transparent. They provide clear and accurate information about their services and charges. They also respect their clients. They listen to their clients' needs and concerns, and they address them promptly and professionally. In the end, services, particularly financial services, are all about creating value. They are about helping individuals and businesses achieve their financial goals. Understanding services as a financial term gives us a deeper appreciation of the crucial role they play in our economy. It also helps us make informed decisions when choosing service providers. Because we deserve nothing but the best. Whether we realize it or not, our lives are enriched by the services we consume. From the hairdresser who styles our hair to the bank that keeps our money safe. Services are an integral part of our economy. They create jobs, promote growth, and improve our lives in countless ways. So, the next time you hear the term services in a financial context, remember, it's more than just a term. It's a testament to the remarkable human ability to create value through action. The world of finance may seem complex and intimidating. But, with understanding, it becomes less daunting. And that's where knowledge of financial terms like services comes in handy. We hope this guide has helped you understand services as a financial term. Stay tuned for more insights into the world of finance. Remember, knowledge is power. The more you know, the better financial decisions you can make. So, keep learning, keep growing, and keep investing in your financial future. Thank you for joining us in this journey of understanding financial terms. Until next time, keep learning, keep investing, and keep moving forward. Unlocking the power of deductibles in finance for your business. In the world of finance, the term deductible holds a significant place. It refers to the amount of money an individual or a business must pay out of pocket before an insurance company will cover a claim. Understanding this concept can greatly help your business. Imagine having a safety net, where a certain amount of risk is taken by your insurance company. That's essentially what a deductible offers. It's a form of risk sharing between you and the insurer. The deductible amount is usually agreed upon when you purchase an insurance policy. This is an important consideration in your financial planning as it directly impacts your premiums. A higher deductible typically means lower premiums, and vice versa. This is because the higher the deductible, the less risk the insurance company takes on. A key advantage of a high deductible is that it can help reduce your insurance costs. This is ideal for businesses looking to manage their expenses effectively. However, it's crucial to balance this with the potential cost if you need to make a claim. A higher deductible means more out-of-pocket expenses before your insurance kicks in. This is where financial planning comes into play. Your business needs to have sufficient reserve funds to cover the deductible in case of a claim. It's essential to remember that not all claims reach the deductible amount. In these cases, the insured party would bear the entire cost. For instance, if your business has a $1,000 deductible and suffers a loss of $500, you pay the entire amount. The insurance company only steps in if the loss exceeds $1,000. Businesses with several small claims might thus benefit from a lower deductible. Paying a little extra in premiums can help manage these smaller, frequent losses. A deductible also helps prevent frivolous claims. If businesses had to pay nothing to make a claim, they might do so for minor issues, increasing the cost for everyone. Insurance companies recognize businesses that choose higher deductibles as being more responsible. This is because they're willing to share a greater portion of risk. To choose your deductible wisely, consider the nature of your business and its potential risks. If your operations are risky, a lower deductible might be safer. Also, assess your financial capacity to pay a higher deductible in the worst-case scenario. If it could potentially strain your finances, a lower deductible would be better. Remember, the deductible is just one aspect of your insurance policy. It's equally important to consider the extent of coverage and the reliability of the insurer. Professional advice can be invaluable in deciding your deductible. Financial advisors or insurance brokers can provide tailored recommendations considering your business circumstances. In conclusion, understanding and effectively using deductibles can be a game changer for your business. It can not only help manage your insurance costs but also significantly mitigate your business risks. The power of the deductible lies in its ability to tailor insurance to your specific needs. It is an essential tool that every business owner should understand and strategically utilize. A well-chosen deductible can provide peace of mind, knowing that your business has financial protection in place. It could well be the key to sustainable success in your business journey. Remember, knowledge is power. Make the most of the deductible concept to empower your business financially and make your entrepreneurial journey smoother. Join us in our next video, where we will delve deeper into different financial concepts that can help streamline your business operations and boost your profits. Until then, keep exploring, learning, and growing. Because every financial decision you make today will shape your business's future tomorrow. Don't forget to like, share, and subscribe so that you don't miss out on any of our future videos. Here's to a successful, financially savvy, and prosperous business journey ahead. End of script.